Hi everyone, Mark Gazzetti here. Let's talk about 2023 year-end tax planning. We're going to cover what your strategy is for this year, either accelerating income or accelerating deductions, how to manage your tax bracket, how to increase deductions, making better charitable gifts. Also going to talk about when to pay your Wisconsin property taxes this year. And then we'll wrap up with controlling Medicare premiums, as well as a look at some 2024 strategies that you can implement. So let's get started. First, let's talk about what your strategy should be. If you're in a high tax bracket this year, probably need to accelerate some deductions and get that tax break that those deductions help out with. If you're in a low tax bracket, you could actually accelerate income and pay more taxes. That can make sense in many cases. And we'll look at an example of that here in a little bit. So how do you determine what your tax bracket is? Well, let's start with your gross income. And an easy way to visualize this is to think of all of the money that you earn as being water in a bottle. And the first thing that we're going to do is we're going to pour out some of that water so that it's not taxed. We're going to pour that water into things like a health savings account, a 401k or 403b on a pre-tax basis. And then you also get to take either a standard deduction or itemized deduction. And so all of that income doesn't get taxed. It's only the income that remains that starts to fill up the tax brackets. They'll start at 10% and go up to 37% on the federal scale this year. Now, as you're filling up the tax brackets, keep in mind that it's only the income that falls in that bracket that's taxed at that rate. So in the example on the screen, we've got some money in the 24% tax bracket, but it's only those few dollars that landed in that 24% bracket that are taxed at that rate. All of the income in the previous tax brackets up to the 24% are still being taxed at that lower rate. So what are those deductions and brackets for this year? So on the left side of the screen, you see the HSA maximum contributions that are deductible, as well as for retirement plans and their standard deduction. So this year, standard deduction for married filing joint is just under $28,000, and for a single individual, it's just under $14,000. Now, tax brackets are on the right side of the screen. MFJ, again, married filing joint, and then single or married filing separately is in the far right column. Let's take a closer look at the itemized deductions to see if we can enhance on the $27,000 or $13,000 standard deduction. So itemized deductions fall on Federal Schedule A, and there's a few categories that people will sometimes have some figures in. So the first is medical and dental expenses. Now, the trick here is that these have to be expenses that you pay out of pocket. They also have to exceed 7.5% of your adjusted gross income to be deductible. Next category is taxes that you paid. This is your Wisconsin income taxes and your property taxes. Now, given the current tax rules that we're under from the Tax Cut and Jobs Act, the maximum that you can deduct in this category is $10,000. If you're a working physician, chances are you're already hitting that $10,000 cap with just your Wisconsin income taxes alone. So paying property taxes doesn't enhance your deduction because you've already hit that cap. The next category is interest that you pay. This is mortgage interest on your home. And then the final category is gifts to charity. And again, you get the higher of the two deductions. You get the higher of the standard deduction or itemized deduction, whichever one gives you the larger tax benefit. Now we can enhance that charitable deduction. So if you're under age 70 and a half, here's a really good strategy to consider for your charitable gifts. What we're comparing here are is the standard deduction of $27,700 versus trying to itemize those charitable gifts. So in this case, we have state and local taxes capped at $10,000 plus. In this example client, they're also giving $10,000 to charity. They don't have a mortgage, so there's no mortgage interest. So their typical itemized deduction would be $20,000. However, they get the higher of the two. They get the standard deduction in this case. So let's take this charitable gift one step further, though, and instead of claiming $10,000 in charitable gifts for each year going forward, let's take 3 years worth of charitable gifts and combine them into one single tax year. And that's what you see in the far right column here. By doing that first year deduction, we actually get to itemize, and it's $40,000. The next 2 years, we add on the standard deduction on top of that. So the sum of the deductions over 3 years is $95,400 versus just simply claiming the standard deduction for 3 years. Now we've enhanced the deduction over that 3-year period of time. So let's look at how that donor advised fund actually works. It's basically a charitable account. We're going to contribute cash, or better yet, appreciated investments, because those appreciated investments we would normally pay capital gains tax on, but we can actually give those to the charitable account, the donor advised fund, and the capital gains tax just simply disappears because a donor advised fund is considered a 501c3. It's a nonprofit, it doesn't pay taxes, and so those capital gains just simply disappear when we make that gift. Money goes into that donor advised fund. In return, we get an immediate current year tax deduction. So this is how we can basically take 3 years of charitable gifts, put it into a donor advised fund this year, and accelerate those charitable tax deductions. Now, we don't have to give the money to charity this year. In fact, you can just continue on with your normal frequency of giving this, but it's going to come out of the donor advised fund rather than coming out of your checking account. Now, the strategy is a little bit different for those of you that are over age 70 and a half. We're going to use what's called a qualified charitable distribution. And this is where you can give money from your IRA directly to charity. So we don't have to recognize it as income first, and we don't have to try to itemize deductions in order to get the tax benefit. And so here's how the math works on this one. So let's start in the far right column here. Let's say that somebody takes $10,000 out of their IRA. Combined with their other income, they have $150,000 of adjusted gross income for the year. They fill out their Schedule A, try to itemize, but in this case, we still have too little to actually itemize, so they get the standard deduction. So in this case, their taxable income is $119,300, which is basically the $150,000 of AGI that they started with, minus their standard deduction. By using the qualified charitable distribution strategy, this $10,000 that they gave to charity, they could have eliminated that from their AGI rate from the start. So that's what you see in the middle column here, $140,000 starting AGI, claim the standard deduction. Now these folks are over age 65, obviously, because you're at least age 70 and a half, so you get a little bit of a kicker on that standard deduction. And lo and behold, we reduced their taxable income by $10,000. Given the combination of the federal and state taxes on this, that's over a $2,700 tax savings each and every single year that this person would utilize this strategy. Now, I can't talk about taxes without tax credits. Tax credits are very powerful. They reduce your tax bill dollar for dollar. And these are hit or miss. So you either qualify for these or you don't. It just depends on what's going on in your life. For example, do you have kids in education? In college, where you can claim the education credit. Perhaps you purchased a vehicle that qualifies for the green vehicle tax credit. And so you'll either qualify for this or you won't based on your own personal circumstances. Let's look forward now at Wisconsin a little bit more, and going back again to that timing of the property taxes. So remember in the example that I gave earlier, paying property taxes on the federal return in many cases doesn't help at all if you're already hitting that $10,000 cap on state and local tax deductions. However, for Wisconsin, there is a small benefit. And so if you pay up to $2,500 in property taxes each calendar year, you can deduct that from your Wisconsin income tax return, or more specifically, you get a $300 credit. So for a lot of people, that's the best that we can do with property taxes right now, is getting that $300 credit. Now, keep in mind, if last year's property taxes were paid in early 2023, you may have already paid in $2,500 and would already get the maximum Wisconsin credit. Therefore, this year's property taxes, you can just delay until those payments are due in 2024. Now, Wisconsin does have some other deductions. However, Wisconsin calls them subtractions rather than deductions. There's like a few of these that are commonly missed that I watch for. And so I want you to pay special attention if these apply in your case. The first is long-term care insurance premiums. There's two issues here. One is that you typically don't receive any kind of a tax form from the insurance company. So as you're compiling all of your data for preparing your taxes, this one's easy to miss. The other issue here is that I've noticed that some tax software programs don't ask about long-term care premiums if you didn't take the medical and dental expense deduction on your federal return. And so that's another easy way that this one gets missed. The other one that's missed often is EdVest. Same issue here. There's no tax form. So my best advice, hang on to your December 31st statement as your proof of contributions for the year. And then you get to deduct a few $1,000s from your Wisconsin income, which results in a couple $100 tax savings by making those EdVest contributions. Now, finally, let's take a look at what can we do regarding our investments and taxes, and how can we adjust some of our taxable income this year. So we're going to focus on that middle column there, the taxable investments. So this is not retirement accounts. This is just your joint investment account with your spouse, or perhaps an individual investment account that you have yourself. Now is a good time to do some tax loss harvesting of those taxable accounts. So the way that tax loss harvesting works is, let's say you bought a stock, in this case ABC, you purchased it for $75,000. However, it went down in value. It's currently worth $52,000 today, which means that it has an unrealized loss. By selling that stock, now it turns into a realized loss, and you can include that on your tax return for this year. Now, realized losses offset realized gains. And so this is a way that you can control how much income you are actually taxed on for this year. If your losses exceed your gains, $3,000 of those losses can actually offset ordinary income, and any amount over that gets saved and can be used in future years to offset either future years of realized gains or additional $3,000 deductions against ordinary income in the future. Let's talk about Roth conversions. This is the scenario of when it makes sense to actually accelerate income and pay more taxes. So here's a very common situation that I see of somebody who is working up until approximately age 62 and 65. We have a married couple in this case. They retire and their taxable income drops substantially low. And it drops there until they get into their mid-70s, when they have to start taking distributions from their pre-tax retirement accounts called required minimum distributions. And so we have this valley on the taxable income between retirement and when those required minimum distributions start. And so the green on this graph represents that taxable income. The horizontal lines going across represent the various tax brackets. So why don't we fill up those lower tax brackets in that valley and pay taxes at those low tax brackets and those low tax rates? Well, in doing that, it can add up to hundreds of thousands of dollars. I've even seen over $1 million of lifetime benefit by doing some proper tax planning and paying those taxes at those lower rates. And so this can be very powerful for those of you that are in those early retirement years and haven't started taking required minimum distributions yet. Now, the other thing we have to be considered about with income is how it affects Medicare premiums. And so these are the rates that can be paid for Medicare premiums in 2024 based on what you reported on your 2022 tax return. We don't have the 2023 figures yet that'll be applied in 2025, but you can assume that they'll be very similar to this. So the idea with Medicare premiums is that the higher your income, the higher your Medicare premium is. And this is one of those cases where you can actually control how much your income is each year by doing things like tax loss harvesting, by controlling how much you take out of your pre-tax retirement accounts. And you can slide under some of these under these income threshold levels that increase those Medicare premiums. Finally, let's look forward to 2024. So we do have the new figures for contributions for retirement plans, for Roth IRAs or backdoor Roth IRAs, as well as HSAs. So plan ahead, get your contributions in for 2024 to start controlling your 2024 taxable income. The other thing to consider is Roth IRA, backdoor Roth IRA. I mentioned that previously. This is a very, very powerful tax strategy, especially if you're early in your career. Here's an example of a 30-year-old putting in the maximum contribution, which is $6,500 this year. It'll be $7,000 in 2024. Having that grow annually at a 7% return, by putting it in a Roth account, it's over $220,000 tax savings as compared to having that exact same contribution and exact same investment inside of a taxable account. So tax savings in Roth accounts are very powerful tax vehicles. Now, for a married couple, That's over $220,000 per spouse. So you can literally buy a home with the tax savings from this type of a strategy. Here's how that backdoor Roth IRA strategy works. As your income goes up, you are excluded from being able to contribute money directly to a Roth IRA. Instead, you have to go through a two-step process. Step one is to make an IRA contribution. Step two is to convert, which is just a fancy type of a transfer from that traditional IRA over to the Roth IRA. If that traditional IRA starts out as being empty and you do this conversion right away, this is a completely tax neutral strategy. It does get reported on your tax return, but it does not increase your taxable income. However, if you do have a balance inside of your IRA with pre-tax dollars, we do need to roll those pre-tax dollars out of that IRA and into a 401k or 403b plan in order to clear out that IRA so that we can do this backdoor Roth IRA strategy and make the tax math work out properly. Finally, one other consideration as you look forward to 2024 is actually to take a look at your 2023 tax return. One of the other things that can add to your taxable income is investment income. And so look at line 2B of your 1040. That's taxable interest coming off of investments, as well as line 7. That is distributions from capital gains from mutual funds, or it could just be realized capital gains that you realized yourself. If those numbers are large, it may be time to take a look at your portfolio and make some changes there to reduce what you see on those lines, use some more tax efficient investments instead, and that'll help to reduce your future total income by managing your investment income. So I hope this walk through the tax planning has been helpful for you. Feel free to reach out if you do have questions. Thanks for joining me. Take care, everybody. Bye-bye.